Good afternoon, everybody. You're watching the Stock Market Brief Show. We are trading in a very precarious area right now in the S&P 500, and it does warrant some extreme caution, albeit the market is, well, doing quite well coming out of that Jackson Hole, remaining in this bull trend, bull channel that we've been trading in. But I do want to kind of call out where the week finished out, how we did today, and then just some of the interesting stuff that's taking place that you might not be able to see via some of the tools that I have at hand. All that and more on today's Stock Market Brief Show. Before we get into today's episode, I want to do a PSA. Once again, we're coming till the month end here of August. My prices are going up for the Discord/Patreon channel. So if you want to be grandfathered in to the $9 a month for everything that I offer there, you can go ahead and sign up. Or you can even do it annually and save even more. It's not going to be a huge price increase. I mean, it might seem like in percentage basis, but it's still going to be a very affordable platform to get all these resources and tools, which include the Tradie Ticks, various commands, all their bots that they offer, and then my own bot that I've been continuing to add to, which gives daily, weekly implied moves. I call that the Asher bot. I gives premium discounts to as well that actually looks at the current IVOL premium and discount 2-day, 5-day, and then the 22-day. And then I have some updates coming to that there as well. But that's not all. We do the watch list, the tight list. I send out my daily expected moves from the options chain, weekly, monthly, quarterly, which I'm going to give you the daily ones today, the list that what it looks like, just so you have some, because it's good for today's talk. And then I give a daily zones fractal view of the markets as well, which is a cool documentation, a cool way of viewing bridge bands across multiple different assets. And then you get obviously access to the Discord. So with all that said, just wanted to give you the heads up that we are going to be increasing prices at the start of next month. And if you want to get in, be grandfathered in now. So we're going to hop right into really today's episode and kind of walk you through what it is that I'm seeing and what I'm preparing for. First, I want to just start off and preface this with the market's bullish. It's hard to have some sort of a crash or something bad happen in these type of conditions. We do have a series of higher highs and higher lows. It's in a bull channel. In fact, last week we kind of sold off, de-risked into Jackson Symposium. Bam, to the lower end of the channel, we ripped higher. Today, it was just an inside trading day, digesting that rather large day. The bearish divergence at the moment, it is still holding as it stands, which tells us the internals are weakening on the move higher here in the S&P 500. Now, if I zoom in just to last week's trading session, which we're looking right over here, where did we close after that big Jackson Symposium move? Well, just slightly up on the week. So as bullish as everyone was, based off of the Fed comments and order flow and all that good stuff, we really did finished rather unchanged on the week. If you take a look at the S&P 500 today and the 11 sectors that make it up, energy finished the lead, and then we had healthcare, utilities, consumer staples towards the bottom of the list, which is typically more of a risk-off environment, and those were the laggards. So, and then energy, being at the top, a little bit of an interesting type of digestive day. But if you look over here, S&P 500 did finish down, digesting its move. Dow's finished down a little bit more than that. S&P 100, which is the larger names in the S&P 500, and then small caps finish down the worst at about 90 basis points with the volatility index up ever so slightly. Okay, this is the net gamma of the S&P 500, and we've been talking about this call wall up here at 6,500 that can act as a potential level of resistance or a pin. And if traders aren't reaching out further, it's very hard to break through these levels until we get some option expirations, until the environment of the market starts to shift. But why I say this is a very precarious, very dangerous little spot in the markets is because this right here, this level is 64.50. And if you just look beneath us, right to the left-hand side of the screen, what is there? There's legitimately nothing hanging out there as far as terms of gamma. And that is a little concerning because if we start slipping off these kind of open holes, these liquidity traps, you can have very fast, aggressive moves in a very short period of time. And that would freak out a lot of people who aren't aware of where other traders are gathering, which this happens to be 63.50. And I believe this is 6,300 right here. So if I pull up the SPX chart and just kind of show you, hey, we are trading roughly at 64.50. We broke out of this box prior. We sunk back in. That we kind of talked about before it happened because Bitcoin led the price, which we'll discuss again today. And then we got out from the Jackson news, and now it's kind of coming back in. So under this 6450, this kind of opens the door to fall right back within this range. And that is where things, as we talked about from a gamma perspective, can get quite crazy. So if we look at where 6350 is, you can see over here, you have 6350. That would bring us down to where this prior low was. And then if we break further, 6,300. But it's not that. If you want a cleaner picture, we can look at the SPOOs or ES, right? This is the S&P 500 minis, E-mini S&P 500 futures. And that 6335 level we talked about a couple episodes ago actually is still there, not over 400 contracts, but it's still there holding relative size versus what else is on the heat map or in the order book. So you have 378 contracts down here, and that kind of lines up in a way around where we just pointed out for the SP. So when I'm looking at this, how we kind of came to the upper bounds of it, we came down. You can see when we came up here, we pushed off, came up here, pushed off. When we came down here, we pushed up. Then we got outside of it. And then when we broke down, we saw a pretty aggressive move. So we went for another move. So I'm saying right at about this 6450 for ES, you just have a lot of things coming into perspective here that you just don't want to slip too far under this 6450 from the SPX perspective and ES futures, because that can just open the door for just an immediate kind of flush looking to where some of those other key levels are. Now, what can amplify this selling if it were to occur? Well, you got to understand, if you go back, right, to the S&P 500 here in April, what drove all the buying here? This is something that we were really preparing for, right? Bottoms are a lot easier to kind of spot out and find than tops are, because tops do take quite a bit of time to form. Well, over when we were down in these areas, we were talking about commodity trading advisors, right? Systematic flows, vol control funds, and how they were very, very, extended, or the selling was quite exhausted from the terms of these charts. And you could see down here in April, we started talking about, hey, these guys are going to become buyers if we start to see some buying hit the tape. And that's what could really drive the market. It wasn't just CTA positioning, but it was also vol control funds down here in April. And all of a sudden they became big buyers. So just as if we were down there preparing for the market to go up, I'm trying to point out, hey, now we're reaching these kind of exhaustive type levels where, yeah, they can still be buyers, but it's getting a little tired out from these specific levels. And what's dangerous here is that they can become sellers. And if they become sellers, that could amplify the moves that we see in this market. So how do we know really when they could become potential sellers in the market? And that is if the S&P 500 starts to slip under its gamma flip line. And the gamma flip line at this current moment is at just under the weekly implied move at about 63.80 on the SPX. Okay, so that would be getting under these levels, at least as it stands right now. It's dynamic, it's always changing, it's updating. People have different models. Think of it more of a zone. This is like the happy place, right? This is where you don't have aggressive hedging taking place, but if you start breaking from them in either direction, you can see quite aggressive moves. Now that we're above it, dealers are looking to, right, buy the dip, sell the rip, buy the dip, sell the rip, and volatility comes in, right? But when you get under it, dealers will sell into the selling. They'll buy into the buying. Volatility will typically increase, and volatility, as we know, is at pretty low suppressed levels. Okay, so we're up here near the JPM collar. We're by that call wall. We've got rejected from here before. I think I've made myself clear that you got to be a little bit more careful and be more prepared for if we start to see sudden moves. You don't want to necessarily freak out. I just want to, if that were to happen, if we're to suck kind of right back into this range or this box, just to be aware that hey, this is probably why that's taking place. So let me do my due diligence and start looking at what the market priced in and some of these key levels on the chart that the market can react from. And I think you'd be significantly better off coming at it from a more leveled mind than potentially freaking out if all of a sudden volatility erupts a little bit in this overall bull market that we are currently in, okay? It's healthy to see pullbacks and consolidations. I thought this chart was pretty interesting. This is looking at Qs, which is in the black line, and then the Bitcoin, I made it in orange. And you typically have a strong positive correlation. I just put a 20-day correlation, rolling correlation here. And you're above the zero line, which means in the higher you're above zero, the more correlated that they are. So if one moves down, the other moves down, one moves up, the other moves up. And you can see that, right, just by looking at the chart. But there is a little bit of a divergence taking place here. We've seen Bitcoin breaking down, and I'm going to talk more about that. And then Nasdaq, hasn't yet. So is Bitcoin giving us like a heads up notice of something potentially bigger to happen in other markets? Is it, this risk on asset, is it kind of leading the way? And I don't have that answer, but that is currently what's taking place now. And there's a strong correlation. So one could believe that, hey, if Bitcoin continues to sink off from here, that could potentially be bad and a good sign for the market to continue its consolidation or maybe a little bit of a pullback. Now, if I look at the Sailor to Shift tool, this is measuring the rate of change between Bitcoin and gold from the 4-week period. And I made a video on this, on how to use it, the strategy behind it. I do want to say that we closed underneath it last week under the zero line for the rate of change, which is the sell signal. And now this week we cross under this prior trading week, which creates the sell trigger. So right now, as it stands right now, for me, my strategy is out of Bitcoin, out of crypto related equities. I think I have a little bit of one still because I'm in the position and it was up. So I just updated my stops and that's it. And now I just simply wait, right? After this kind of sell off, it's overall just in like a consolidation. It doesn't look all too crazy, but this has caught big pullbacks in Bitcoin throughout history. So I don't want it to turn into one of those type of an event. Now, if this starts crossing back above the rate of change and give me a buy signal, buy trigger, I'll be more open to getting back in and getting more exposure to these crypto related assets, including Bitcoin, Ethereum, and so forth. Now, if I look at Bitcoin by itself, we had a little bit of a bullish, bearish divergence here. We popped up higher. We talked about how it came back in and how it could potentially lead the S&P 500 in on a prior episode. It did, and now it's kind of breaking back down to the lower bounds of this channel. But overall, we still see a series of higher highs, higher lows. So it's nothing absolutely out of this world. If it were to continue to sell off, maybe look at around 100K, that big round number where we've seen the confluence with the 200 period moving average and where we kind of ran into other prior areas of support. Okay, cool. Takes it from 110 to 100,000. Maybe there's some opportunities in there. The Bitcoin relative strength line to S&P 500 did cross beneath the 50 period moving average. And, we have done that before quickly over here. It's been throughout this period, which led to some pretty bad sell side activity. And then when we started really kind of crossing back above it, it did lead to a nice run. And as you can see, as price has been kind of going sideways and higher, this has been falling off. So maybe giving us a little insight to some further weakness in Bitcoin. But after 3 strong days of selling, I wouldn't be shocked to see this bounce at some point back up to around 115, right? That seems like it was an area of support. We broke through, shot back up, and then kind of doodled around there. So at some point, come back to 115, see what it does. Maybe we get a better signal from that point, but that's where we stand at this current moment. The dollar saw a little bit of a bid today. Overall, just kind of been going sideways. Sorry, my things all messing up here. Overall, been going sideways. Can't get too great of a read, but we did add a while ago, we talked about the bullish divergence here that led to a nice rally. And then we've been talking about the bullish divergence here, led to a nice rally, and is still kind of holding up. As far as the 10-year yield and oil has risen today, right? And it's been kind of bouncing. We've been preparing for that. A lot of energy stocks were coiling up. Saw some good moves there, including today and on Friday. So that's awesome if you got some exposure into some energy names. But then you look at the 10-year yield. This one's up on the day slightly, and these typically follow very closely. So is oil, if it continues up, is it telling us that the 10-year yield might try to make its run back up to 4.4, maybe 4.45, maybe even 4.5, which would be a pretty intense move. I did find this a pretty interesting chart. This is just looking at the relative strength line on a weekly basis for consumer staples relative to the SPY. So basically, when this line goes up, it just tells us that people are more interested in the wants, like things that you needs, consumer staple products, versus the wants and the rest of the market, right? So this when the line goes up in short, it's more of a risk off type move. And you could see that, right? This line goes up over here. We had the dot-com bubble. This line over here, that was the financial crisis, right? Over here was the 2022 bear market, right? Over here, boom, pandemic, and so forth down the list. This goes on and on throughout the chart. The reason why I find it to be interesting now, and this is by no means a timing mechanism, is that the relative strength of consumer staples relative to the SPY is reaching down to a level that we haven't actually seen since ever, right? This is the dot-com bubble top, actually, surprisingly, reaching up to those levels when things were getting all crazy. And I do find it kind of interesting because we have this AI bubble going on right now, or all this AI craze, and certain stuff like that, and we're reaching into these kind of extravagant levels. Now, mind you, this can still go down, this can go up, but I did find it to be interesting. And I also want to point out, this doesn't necessarily mean consumer staples do good if the S&P 500 falls. It just means that if this line goes up, consumer staples could potentially go down too, just at a lower, slower pace than the S&P 500, meaning it outperforms it from that absolute relative basis. Okay, another thing that I find interesting here is back month versus front month volatility. This is still above 20%, and this is typically where we go through periods of consolidations and pullbacks. So we were talking how volatility has been coming in and how it could potentially pick up very quickly if we go over some of those key levels. And as volatility is coming in, this also kind of gives me that insight saying, hey, last time we were up at these levels, what was this brown line doing shortly thereafter? Oh, we saw a spike in the VIX. Oh, we saw a spike in the VIX, right? We came up to these levels, we saw little spikes in the VIX. Okay, so it is coming to an interesting kind of inflection point amongst all these different signals and indicators going on. If I take a look at the expected moves today, we came down into the lower daily implied move, still remain above that 5-day moving average. I'm going to go ahead and update you on what that looks like and then give you the rest of the daily expected moves for some other products. We have the weekly implied move up here at about 653.52 and down here at about 637, which would bring us down into really just kind of wiping out the Jackson Hole Symposium speech and getting us back below the 5-day moving average that is still inclining and it's still positive. I did call out to watch for this last week's week-to-date VWAP. So that's there in confluence with the lower daily. So if we could drown off, maybe we get some bounces. I don't know if it's going to turn into something bigger, but those are some levels to watch for markets to respond at going into tomorrow's trading session. That's all I got for you on today's episode, everybody. If you want the rest of these daily expected moves on your chart, you can sign up for the Discord. This is for tomorrow's day, right? So S&P 500, only $26 expected move, which means, right, the SPY is 2.73. These are very low implied moves taking place right now, given the context of where volatility is. So it makes sense, but we're also kind of at that, just right at that level that it feels like we're kind of on a cliff where we can see a kind of a scary moment happen. That's not necessarily anything to overly freak out about, but I thought it was important to call out. And that's all I got for you on today's episode. I hope it helps out, gives you some insight. I'll see you on the next.